Hello everyone, I'm Miles. Today we're going to look at a hypothetical retail startup, Miles Incorporated, and see how the three major financial statements change step by step after the company purchases $300 worth of goods in January 2025 and then sells $800 to customers in March. Let's learn as we go. Are you ready? Let's get started. Step 1. Purchasing inventory. Miles Incorporated spent $300 to purchase products. There's no revenue. Note how statements change. Cash decreases by $300, inventory increases by $300, and the balance sheet stays balanced. Pretty simple, right? The company is just moving money from the bank into the warehouse. Before we continue, let's quickly review inventory accounting. For manufacturing companies, there are usually three types of inventory: raw materials, work in process, WIP, and finished goods, FG. Raw materials go through the production process to become work in process and then turn into finished goods. Only when the finished goods are sold does that portion of inventory enter the income statement and become cost of goods sold, or COGS. For retail businesses, whether it's a traditional supermarket or an e-commerce platform, things are much simpler. There's only one type of inventory: finished goods. Once sold, the portion of inventory that was sold goes directly into the income statement under the cost of goods sold COGS account. Step 2. Selling the inventory. 2 months later, Miles Incorporated sells these products for $800. The income statement lights up: $800 in revenue, $300 in cost of goods sold, $500 in pre-tax profit, minus $100 in income tax at 20%, leaving a net profit of $400. Looking at the cash flow statement, starting with $400 increase in net profit, plus $300 cash released from inventory reduction, $700 in new cash inflow. What about the balance sheet? Cash increases by $700, inventory decreases by $300, equity increases by $400, net assets increase by $400, and equity increases. The balance is maintained. What's the overall effect? Company turned $300 cash into $800 sales, paid $100 taxes, $400 profit, while cash also increased by $400. Key point: finance isn't rote memorization, tracking the journey of money. Cash turns into inventory, inventory becomes revenue, revenue is converted into profit, and profit accumulates as equity. Hold on to this thread, and you'll see the lifeline of a business. Solving problems is learning. From now on, the way you look at financial statements will be completely different.